Hello, and welcome back to the Lazy Money Game. In today's episode, I will be covering what I have done throughout the week. I will show the guidelines I'm using in order to add companies to my portfolio, and I will even walk you through a concrete example so you can get a better understanding of how I evaluate companies in order to add them. At the same time, I would really like to highlight that you can see in my portfolio that I'm currently down. Is it something that concerns me? If it's something that I'm worried about, that I've actually lost more than 1.5% in the last week. At the end of the video, I will actually highlight why I think it's a valuable lesson to learn that I'm down more than 1.5% within the first week. So without further ado, let's jump into it and see what I have actually done within the last week. Let's begin from the top. You can see that I have added $7,000 more into Macy's. On second place, I have Abri, where I have added $5,000 to my current position. On third place, I have Wells Fargo, where I have added $4,000. Then we have an entire new holding in my portfolio, which is Tailored Brands, where I have added $3,000. Then we have Simon Property and Bank of America, where I have added $2,000 into each. And finally, we have a new position in Suncor Energy, where I have added $1,000. So in total, I have added $24,000 within the week, which is a lot of money to me. But I'm simply just showing you this in order to give you a better understanding of what I am doing. Hence, it will come as no surprise that the pie chart for the portfolio has changed quite a bit since the last episode. For instance, energy, that's a completely new holding, since I didn't have anything in that sector previously. You can also see that I have increased a lot in my consumer cyclical, since I have added so much into Macy's. After the first video, I have received some questions about how you actually follow this dividend growth investing strategy. I don't want to set out rules as such, but I wanted to give you some clear guidelines. So firstly, you want to evaluate companies which has a yield above 3%. The reason why I have chosen 3% is simply just to get this snowball effect. You want to be paid dividends that actually matters. And if you're starting with small numbers, then you will start receiving pennies if you're below that yield. Secondly, you do not want to pay too much for the company when you actually buy it, since you're starting to build your portfolio. You want to have the most bang for the buck. So in order to do this, you look at the forward dividend yield and compare it to the 4-year average yield. You want to buy a company that has a higher yield forward than its 4-year average yield. This can easily be seen by using the webpage Seeking Alpha, as it was showed in the first video, just to give you a clear illustration of what to follow. However, just because you think there is an attractive price on the company that you're looking at, you should still compare it to its peers, meaning even if the forward yield is above the 4-year average, you still want to examine the PE ratio to see if it's in line with its peers or even below. So you're not paying too much for your company compared to its competitors, because maybe there's actually a better deal out there for you. Fourthly, you want to be looking at the payout ratio. You want it to be below 75%, because you only want the company to pay out some of the profit. You don't want the company to be paying out all of its profits, because the company needs to have some money left in order to keep on doing research, keep on developing the company, so they will continue paying you dividends going forward. You can of course argue that maybe you should set it to 60% or 70%. I simply just think that 75 is suitable for me. You might have a complete different view there, of course. Fifth, you want to diversify across sectors, meaning that you do not want to buy only oil companies or only consumer staple companies. You want to diversify across the different sectors, so if the sector as a whole are in trouble, then it's not your entire portfolio which are in trouble. You want to buy companies which has a good dividend history. This can easily be checked by using the Seeking Alpha webpage. Here you can see if the company is increasing its dividend quarter over quarter, year over year, in order to see if it follows the guideline. The final point that you want to investigate is a strong company potential, meaning are the company selling a product which is relevant today but will also be relevant in the future. And at the same time, you want the company to have a competitive advantage, also known as a good moat. For instance, a medical company having a patent, or a company like Facebook where their product is actually only useful if there is a lot of people using it. The more users, the more beneficial it is for all the users who are there. When should you sell? If you simply do not believe that there is a future for the company, meaning that the company is producing a good today which won't be relevant in the future. Secondly, if the company cuts their dividends, meaning that the company is actually in big trouble. If you have followed the guidelines for buying the company, then those companies will do a lot of work in order not to cut their dividends. They are even willing to take a debt simply just to pay you the dividends. So if they cut the dividend, that means that it is a clear indicator that you should consider selling the company. The downside to only selling the company when they have cut the dividends is that the share price most likely already have fallen quite a bit. The final point on when you should sell can of course be argued, because that's not really in line with the buy and hold forever strategy, which dividend growth is actually all about. But I allowed myself to put it in as a rule of thumb, saying if you're actually holding a company where you think that it's extremely overvalued, then I really don't see any point of holding it, because it's most likely that it will fall in the future if you're right. So I would of course consider selling that. Even though I have made a lot of effort into putting my guidelines as precise and to the point as I possibly can, I still must admire one of the world's greatest investors of all time, Warren Buffett. He don't present guidelines, he simply has 2 rules that you need to follow. Rule number 1, don't lose money. Rule number 2, remember rule number 1. However, if I have simply just presented these 2 rules, I'm pretty sure that I would have left more questions than answers. What better way to understand the guidelines than going through a concrete example? So let's take a closer look at Macy's and see what the guidelines is actually all about. So first of all, we take a look at the dividend, and we see here that it's clearly above 3%. Next, we have to go to the dividend yield tab and see that the forward yield is currently much higher than the 4-year average. So point 1 and point 2 already checks out here. Next, we have to take a look at the peers and see if we are in line with those according to the PE ratio. So let's look at point number 3, whether or not Macy is in line with its peers or below. So hence we go to the peers tab. This is also a really nice feature that Seeking Alpha provides for free, or at least the details that we need is for free. As you can see here, there's a lot of features which is not provided for free, which you have to pay for. But we just need some companies to compare against, and this can easily be done. So you see that you have Macy's over here. You can see all the different features, that market cap, enterprise value, number of employees, how many analysts is currently covering the stock, and so on and so forth. But what we need for point number 3 is the PE ratio. So we scroll down, we see that Macy's is definitely below the 2 other companies, so it's definitely in line or below. Oh, and by the way, this company is currently not profitable, hence there is no PE ratio. Fourthly, we have to look at the payout ratio, and we can see here that we are well below the 75%. Fifthly, you have to look at the diversification towards your portfolio, and as you can see here, my portfolio only holds 32% in the consumer cyclicals, which is where Macy is placed, and I really think that Macy is currently undervalued, hence it is by far my biggest holding in the portfolio. Let's take a closer look at guideline number 6, dividend history. So when we look at the dividend scorecard, we can see here that it hasn't been growing its dividends. That means that last year and this year there has been no growth in the dividend history. Then let's take a closer look and go to the dividend history. And as we saw on the dividend scorecard, we can see that there has been no increase in the dividend since 2016. However, if we expand and see all the historical dividends, we can see that the dividend actually has been increasing since 2010. However, the dividend increase has slowed down, meaning that there has been absolutely no increase in the dividend over the last couple of years. But given that the dividend currently is so high that we are yielding more than 8%, I think it's safe to say that this point actually checks out from our list. As I mentioned when I walked through the guidelines, point number 7 is by far the hardest one to determine. So if we start by looking at company potential, let's see what Macy is actually all about. I simply just Google Macy's and go into the About page. So Macy is an omni-channel retailer. They have approximately 130,000 employees, 871 stores, and they are located in 43 different states. So the question we need to ask ourselves now is, do we believe that there will be a future for an omni-channel retailer like Macy's, or do we think that there is so much competition that Macy's will go out of business? When we want to address the competition, we can simply go back and take a look at the PE ratios that we saw under point number 3 in the guidelines, the PE ratio. Here we can easily see that even one of Macy's competitors is struggling so much that they actually have negative earnings. So there is, of course, a lot of competition. And I believe that even Macy's biggest competitors is not even mentioned here. Amazon, for instance, they are really huge on online sales. And going forward, you need to ask yourself the question, how much of retail sales will actually be done online, and what have Macy's done in order to secure a large market share of the online retail sales? In order to answer that question, I have simply gone into Macy's webpage under Investors, Financial Info, Financial Result, and then looking at the presentation they gave about the Q3. So Macy's has of course addressed this with taking some initiatives on launching some online sales. And you can see here that they actually have a triple-digit growth in the app downloads year to date. And this is actually their largest growing business at this point. At the same time, we can see that Macy's has finished Growth 150. This was a project they initiated in 2019, where they are trying to improve some of their stores in order to get them more profitable in the future. So they are very well aware of the competition and are trying to handle it to the best of their knowledge. So now we have seen that there definitely is a lot of competition. But I think that Macy's has done a tremendous job in order to stay relevant going forward by taking these initiatives like Growth 150 and their mobile launch. But of course you can argue that the economic mode is challenged since there is so much competition. Maybe that is why the stock is down from its top of 72.31 and all the way down to 16.78. That is actually a decline of more than 75%. In the same time, however, Macy's earnings is down about 10%. And if you actually look at the stock price, saying 16.78 today, that gives the company a total market cap of 5.18 billion. But if you take a closer look at the property and equipment, you can see that the current market cap of Macy's is actually below its property and equipment, meaning that if you were to liquidate the company today, the property and equipment will actually be worth more than the share price is currently trading at. That's why I really feel that this is a bargain, and that's why I have bought it. So now I have explained the guidelines and I have showed you how I have applied them with a concrete example with Macy's. I think it's time that we take a look at the change of my portfolio and why I actually think it's a valuable lesson that I'm down more than 1.5%. So even though you have done your research, you have investigated as thoroughly as you can, you will never be able to time the market ideally. You can never predict what will go on out there. So for instance, this virus that is currently going on in China, you had no chance of predicting that, and that has actually affected the stock market, and that is why we're currently down. However, I do believe that the investments that I have will be great going into the future, because just because there's a virus in China, that does not affect the way that my companies are delivering in the future. So hopefully I have answered the questions regarding the guidelines and how you can follow them in order to do this dividend growth investing strategy. So that's it for now. So remember to like and subscribe the channel so I can keep producing more valuable content in the future. And until I see you next time, bye!